This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look at a wave of new books that show capitalism may not be doomed. I'm Nathan Hager in Washington.
I'm Caroline Hepker here in London, where we look at Bloomberg Intelligence's best ideas for European stocks in 2026.
I'm Doug Krisner, looking at the outlook for Asian equity markets in 2026.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager. We begin today's program with a look at some new books that argue capitalism isn't doomed, just misaligned, and fixing it may mean rebalancing the relationships among markets, states, and workers. It's the subject of a Bloomberg opinion piece titled "The 5 Forces That Broke Capitalism and One Fix," and we are joined by that piece's author. He's John Authers, columnist for Bloomberg Opinion. It's great to have you with us, John, because I'm always down for a good book recommendation, and there are a lot of books out right now on the crises of capitalism.
Yeah.
I think you've sifted through, like a dozen of these?
Yes.
So can you pick out any themes in particular that stand out from some of these tomes?
Well, first of all, the popular phrase involving Sherlock Holmes might come up here, but capitalism is in a crisis. Nobody seems to disagree with that. But the key points that keep coming again is that capitalism has reinvented itself on many occasions. It's an amorphous beast, and that is why it has survived as long as it has. And the odds are that it will eventually do that again. Another key point that keeps coming through is that capitalism is always and ever a partnership between the state and markets. Markets can't work unless you have somebody acting as a tough referee at the very least, which needs to be some kind of a politically legitimate state. So you always do actually need government, and the different models of capitalism that have worked have involved different basic compacts between the government and the markets.
So let's walk through some of the crises that capitalism has gone through in the past. I think from what you've been reporting, there's been like 4 different forms of capitalism in just this last century, right?
Well, depending on exactly how you define what we have at the moment. Capitalism, there's one of the most interesting books, but also one I have to warn anyone out there is an extremely long book. It's 1,300 pages.
Oh,
just called Capitalism by Sven Beckert, who is a history professor at Harvard, and this is basically a life's project. So there were many different precursors, but what you can truly recognize as capitalism comes together from a confluence of factors in Britain with the Industrial Revolution at the beginning of the 19th century, and then really becomes its first clearly defined form after Britain wins the wars against Napoleon and starts on the century of British dominance, so that you have industrial might behind it, and then you have trade with the colonies to internationalize it, because capitalism always needs to be able to expand. And that was a model of fairly laissez-faire version of capitalism that was adopted by Americans and used by Americans through the Gilded Age to eventually overtake the UK at their own game. There was a lot of inequality. You need to read Dickens or Steinbeck to see the kinds of problems that could arise. Mm-hmm. And it only really fails, it really collapses in 1929 with the Great Crash and then with the Depression. From that, you get Capitalism 2.0 eventually emerges, the elements of that, the post-war settlement at Bretton Woods, the New Deal. Keynes is the motivating figure on this, described often very wrongly in the US as a socialist. Keynes was a liberal. And he continued to be a very active political member of the Liberal Party at a time when the Labour Party in Britain was actually in power, and it certainly would have behooved him to become Labour. So despite what some people may say about Keynes, he was a capitalist, but one that certainly believed in much more of a role for government than other capitalists do. This model, again, particularly in the environment after the war, works very well for a while. It gives us the GI Bill, gives us the Marshall Plan, and it's based around the US dollar, with the US dollar itself being linked to gold, and it falls apart when America realizes it can no longer afford all the new society welfare state it has built for itself and its misadventure in Vietnam. And so Richard Nixon ends the tie to gold. And then you get a new version, which we would all, I think, naturally connect with Ronald Reagan and Margaret Thatcher. Neoliberalism, giving markets much more of a role in a globalized capitalism with low barriers to trade, free flow of capital, and financialization, which again helps win the Cold War, works wonderfully well, but again collapses under its own weight with the global financial crisis. So we are now in a situation analogous to the 30s or the 70s, when there was an intense intellectual ferment. You can certainly see an analog to that in the amount that intellectuals are pounding out different ideas of how capitalism might be made to work now.
Speaking with John Authers, Bloomberg Opinion Columnist, about the crises in capitalism that have built up over the last century, leading now to a time where it seems like capitalism is really being disrupted by artificial intelligence, while at the same time the response from the government is protectionism. It seems like those two ideas really butt up against each other.
Yes, and that is the issue. It will resolve itself in another 10 or 20 years. It will be obvious what was going to win. We had Obama tried as what you might call a kind of return to, Keynesian-ish capitalism, which people didn't want. The Tea Party revolt was about limited state, going back to more of a laissez-faire version. That didn't really take hold either. And then you had the World Economic Forum, the whole idea of ESG capitalism, of stakeholders becoming more benevolent, taking a broader interest in their ownership of companies. That's also a model that's now, I think, been decisively defeated by Donald Trump. So we now have this return to something that is barely even capitalism at all, of mercantilism, treating the world as a zero-sum game, and the US government basically deciding it can behave like China has been behaving for a while and intervene in the private sector at will. You could call that state capitalism, crony capitalism, but it's plainly a model that has had appealed and that has worked at times for a while. But then you also have, with any form of capitalism, it needs to be able to grow. Otherwise, it won't keep enough people happy with it. The best chance of growing is if you can somehow or other improve productivity. That was part of why Britain had its generations in the sun, because it worked out before anybody else how to boost the productivity of mills and factories in the Industrial Revolution. Now, the argument now is that AI may actually be, it's not like one of these periodic crises within capitalism that I was talking about, like the 30s and the 70s or the GFC. It could be more like another industrial revolution. It'll change the nature of work, change what capital can do as profoundly as that did. And that would be wonderful at one level, in that would promise, if you can get that much more productive, to create the money, create the wealth that would enable you to deal with the inequalities that many people find unbearable. The problem is that it would do that by, it's a very common estimate, I now gather, for as many as 70% of jobs not to be needed anymore. How do you reconcile any version of capitalism? Needs the consent of people, it needs the consent of states, it needs to overlap with some kind of democracy. If it means 70% unemployment, that's not going to fly. So that leads to this fascinating argument, which I now understand far better: universal basic income or something like it. You would have under an AI world, if AI is as potent as we think it is, you would have to have more redistribution because so many human beings would be rendered irrelevant. So how are we going to do that? It plainly involves some kind of a more active state to oversee that than we have had under neoliberalism, under Thatcher and Reagan's model. Are we prepared to allow the current companies that dominate AI to continue to do that, or do we need to rein them in somehow? And then who is actually going to decide how to share out the wealth? Andrew Yang, the presidential candidate, referred to it as the freedom dividend, the idea that everybody would be given a basic income. There is Victor Schvetz of Macquarie, who wrote one of the books I've been writing about, suggests that it would be more of a compensation payment for irrelevance. And there are fascinating arguments on either side about this, that maybe enforced idleness will allow us to go away and write novels, performing plays, do yoga, Pilates, or whatever, that this could be a spur to great creativity and to the finding of new jobs. But obviously you can also imagine it turning into something quite dystopian. But it does raise the issue, if you're going to create a technology that means that we don't have a use for half of the people who might want to work, what else are you going to do? Because that's not a fair system that people will go along with unless you find some way to deal with that. If AI succeeds as hoped, then it really could deal with a lot of the issues of scarcity, that it does turn us into a position of abundance, that we really can create enough for us all to get by happily. But the cost of that is that it would require a massive reimagining of what we want a state to do, what we, the people, want to arrange our society. You can say this is a democratic state that's ultimately chosen by us. Somehow or other, there is a relationship between what people decide in elections and what markets decide in markets, in buying and selling. And you need to find a way to reconcile those two, which will almost certainly be different from any model of capitalism we've had so far.
Our thanks to John Authers, columnist for Bloomberg Opinion. And coming up on Bloomberg Daybreak Weekend, we discuss a fresh perspective on European stocks for the new year. I'm Nathan Hager, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in the program, we'll look at how equity markets may fare in Asia next year. But first, 2025 has seen explosive growth of tech stocks, the toll of tariffs, and the hunt for rare earths. In Europe, the benchmark Euro Stoxx 600 index has seen significant outperformance, with record highs both for that index and the FTSE 100 in London. So what's in store for stock pickers in 2026? Let's get more on that now from Bloomberg Daybreak Europe anchor Caroline Hepker in London.
Nathan, if you're thinking of some New Year's resolutions, perhaps Bloomberg Intelligence can give you a helping hand. The team, who track thousands of companies all over the world, have come up with 50 of the most interesting stocks to watch that you can resolve to keep your eye on over the next 12 months. And joining me now to discuss is Bloomberg Intelligence's Director of Equity Research, Tim Craighead. Great to see you, Tim.
Pleasure to be here.
How did you come up with the ideas to begin with? I suppose, how do you think it's going to be helpful to people?
Yeah, so these 50 ideas, which we do as a little annual effort, are part of a broader group of what we call focus ideas. And these are ideas that have three pillars. One, we have a high conviction fundamental view. Whether it be revenue, earnings, margins, a new product, whatever. Secondly, it's different from what the market thinks. It's out of consensus. And thirdly, there are catalysts ahead that we think will affect change in market sentiment. And these 50 all have catalysts coming up that are important in 2026. We think market sentiment will change.
Interesting. So the selection is global, but I want to focus in mostly on European companies. And thinking about 2025, the strength of European stocks has really caught many people by surprise. Is that thought to continue into 2026 overall for the European market?
Yeah, it's interesting. There's this old phrase about U.S. exceptionalism. And you look at the last 15 years, the U.S. markets have outperformed, broadly speaking. But in 2025, the U.S. wasn't that exceptional. All markets were exceptional. In fact, if you look Europe, you look emerging markets, you look at the U.S. as well. And, the European market for the past 12, 18 months has, in fact, done, as you said, markedly well. Interestingly, it's been for a very different reason than, say, what we saw in the U.S. There, it was all earnings-driven. Valuation did rise a little bit. It is a lofty market multiple now at 20-plus times forward earnings. Europe, interestingly, at only 14, 15 times at this point, the gain has been all valuation. Quite often we talked about how cheap Europe is relative to the U.S. That discount has narrowed, and this whole move that we saw in Europe this year has been, like I said, because of valuation rise. 2026, we think, is a different game. We don't foresee a big multiple expansion from here. We need earnings. And if tariffs are back burner, that was yesterday's story, if economic recovery slowly comes about in 26, we think that there is earnings growth to come through. That's what's really needed to drive the market higher from here.
So you've picked about 17 European companies. Many of them are industrials that you've got sort of on your radar. Why, and what do you think is going to drive that sector in 26?
It's interesting with industrials, probably more than any other group. It's a really diverse set of actors, if you want to think about it that way. ACS, big Spanish engineering company, it's on the list because it owns a company called Turner Construction, which is the U.S.'s largest contractor building data centers. It's an AI play. In contrast, you look at Alstom, it's trains and train equipment. It's all about a new integrated signaling system across Europe that they're putting in place that we think is driving revenue going forward. So drastically different. Kion, they make forklifts, but they have electric forklifts, and distribution centers are going through a change with decarbonization, electrification, and it plays right into Kion. Sodexo, is that really an industrial? Well, from a classification perspective, it is. It's food service for hospitals and schools and, corporate cafeterias. They've had 2 years of negative earnings trends. A new CEO is in. We think there's a change afoot to improve what's been pretty low retention of existing clients, and that's really where they fall down relative to peers. So it's a very broad group of different, very specific ideas.
European financials have been really big winners in 2025. I suppose, can that continue? I wonder whether it's based also on the idea of the central bank, of the ECB, maybe a pivot on European interest rates.
So a couple of thoughts here. 3 European financials are on this list, but I'll put it in some broader context. One is Danske Bank. It's Scandinavian bank. We do see growth picking up there. They've been constrained on what they can pay in dividends because of a regulatory issue from a couple of years back. That now is over. We think dividends and payouts are going to be improving. Same thing with a company called OTP Bank, which is Hungarian, where earnings are doing well. We think growth is going to be good, and they're going to increase their dividends. Not on this list, but also a focus idea is Barclays. And that plays right into the story you're talking, and our broader European banks team does think, a potential ECB shift the other direction. You've got a steepening yield curve. You borrow shorter term, you lend longer term. That's good for net interest margins. They think that the European bank group is pretty positive.
Okay, so one to watch in terms of banks. But we can't exclude artificial intelligence, which I have learnt such a tremendous amount when I think back to January 2025. downloading half a dozen brand new AI apps to figure out whether they could help my work, my research, my life, and think that's what everybody else was doing around the world. How will artificial intelligence help a European market that is largely without big tech names?
Yeah, I mean, it's very true. So a couple of thoughts here. We do have ASML here. It is not a focus idea right now. It has been, and we think about it. That's the pure play. SAP is a focus idea, not on this list. We like it, but it's sort of a secondary play on AI and how that's driving cloud software. The big elements from a European perspective are twofold. One, are there secondary enabling type companies that you can take advantage of? I mentioned ACS earlier, the infrastructure play. That's a classic case in point. A third way, which is even more indirect, but frankly we think is the real longer lasting item, is companies across different businesses actually implementing AI to drive either revenue or efficiencies or margins. We just published a new C-suite level survey where we talked to 600 companies in depth across 9 different industry groups. And it was all about what are you doing to take advantage of AI? And it was quite constructive from the standpoint of there are revenue opportunities, there are efficiency opportunities. It's not about cutting workforce at this point. There's been some announcements, some of which might have been sort of using this as a scapegoat, but that's not the primary aim for AI, far from it. So I think it's going to be one of those behind the scene opportunities to drive better earnings in Europe from an implementation vantage point.
Okay, so that on artificial intelligence. Yes, I wonder if the surprises will continue in AI in the year ahead. Well, there's also pharma, which has been very much dancing on the point of that Trump tariff pin. But you've picked out some biotech names to think about. Indeed.
And those biotech names, they happen to be, U.S. as they are, but it goes in. There's a number of names on the list that are new product innovation type stories. And, we actually have had a European biotech recently on our focus ideas, Revolution. But, it kind of did what we expected it to do. And, we've taken a step back. But Bridge Bio has a new drug to deal with dwarfism, which actually is a much bigger problem much bigger ailment than you might think, especially for kids, and getting them on something. This is an oral therapy. It's easier to take, and it's great. There's another alninum, if I pronounce it correctly, that is a new therapy for thickening heart walls, which again, you don't think is a common issue, but it's a big revenue opportunity for this little biotech company. And broadly speaking, in pharma, it's a really interesting area we're quite focused on as we look into 2026, because we are past the scare of Trump pricing policies. We're past the concern about tariff this or that, it seems. And as we look ahead, there's a massive wave of new product development in areas like oncology that big European pharma companies are quite exposed to. Think AstraZeneca as a case in point. It's probably the best new product positioned company across global pharma, in our humble opinion, our pharma analysts' opinion. So interesting companies ahead. The other item to watch out for is there's also the biggest patent cliff coming up in the next 2 years facing global pharma. It's as much of a U.S. as it is a European issue. There are really interesting dynamics in the area of pharma.
Yeah, very interesting with drug discoveries, as you say. And lastly, you're toasting perhaps a good year ahead for Diageo. Why?
Yeah, really interesting. Because I like Scotch, and I'm just joking. Although I do. They've suffered a couple of years of negative earnings revisions. Too much inventory in the U.S. China was a big growing market. It's faltered. We think things have been cleaned out. There's a new CEO who's starting. We think that there's a recalibration, new initiatives, and if there is a broad backdrop of a better economy in 2026, U.S., European, it's a pretty good backdrop for Diageo.
Okay, I might stick to grapes myself. Wonderful. We have some fresh ideas for 2026 to power us through the months ahead. Tim, thank you so much for giving me some of your time. Tim Craighead is Bloomberg Intelligence's Director of Equity Research. Thank you. And I'm Caroline Hepker here in London, and you can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Nathan.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, we'll look ahead to what's in store for Asian equity markets in 2026. I'm Nathan Hager, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Turning to Asia now, where many equity markets appear set for a dynamic new year. For more, let's get to Doug Krisner, host of the Daybreak Asia podcast.
Nathan, in the last year, many questions loomed over the Asian equity markets. One dealt with the outlook for artificial intelligence. We remember well the DeepSeek moment. It suggested China was closing the gap in the AI race with the U.S. Now, the AI trade also raised questions over valuations. And at the same time, there was a lot of anxiety over how Asian exporters would be impacted by U.S. tariff policy. And then when it comes to China, of course, questions surrounding the property market as well as the story on domestic demand. So as we head into the new year, let's consider the outlook for Asian stocks. I'm joined by Bloomberg's John Lee. He is research content manager for the APAC. John joins us from our studios in Hong Kong. Thank you for being here. So I just highlighted a few of the concerns, and it seems a number of these issues were also on the minds of U.S. investors, as if there were parallel concerns.
Yeah, there definitely was parallels. Now, the biggest driver for Asian equities was, same as the US, like the artificial intelligence or AI trade. And if you look at the markets that really did well, like South Korea, Taiwan, Japan, and China, it's all because of companies that were levered to the AI theme. So I'm talking about companies like SK Hynix, Samsung Electronics, TSMC. So that was a big theme. There were other themes as well. Defense was a big issue in Asia, especially with the continuation of the Russia-Ukraine war. So some of the biggest outperformers were defense stocks as well, like you had Mitsubishi Heavy and Hanwha Aerospace.
I'm curious about participation. Do you have a sense of whether the gains were primarily due to retail investors or whether institutions were helping to drive these advances?
That's an interesting question. We've done some analysis, and the initial jump up in the share prices, especially in Korea, which was the biggest outperformer this year, was led by domestic institutions. And then the second leg was driven by foreigners coming back into the markets, but they were reducing their underweight positions. And recently, we've seen some participation by retail investors.
I'm wondering about the flows. I know there's been a lot of Asian participation in U.S. markets contributing to the gains that we have seen for U.S. stocks. Do you expect some of that capital to be repatriated back to Asia as we look ahead to the new year?
We do believe so, but having said that, we haven't really seen significant signs of that happening. Now, if you look at Asian capital investing overseas, for example, since COVID, Korean retail investors poured in over $100 billion of money into US stocks, predominantly the Mag 7. And we've only started to see them repatriate money, but not in significant size. They've pulled back about $1 billion so far. So there's still a lot more to go.
Let's move away from the Asia Pacific and look at India. Now, the gain that we saw for the Nifty 50 was not nearly as strong as for markets in the Asia Pacific. What is your sense of what's happening with the market in India right now?
Yeah, so India is an interesting market because that was the one market where foreigners were overweight heading into the beginning of this year. It's got a great domestic growth story. It's got a young population, and the government is improving its infrastructure. But having said that, it's really lagged some of the North Asian markets because it doesn't really have the AI theme behind it. This comes as a surprise to many global investors. Like if you look at India's got a lot of talented engineers. It's also, some of the biggest US tech companies are, led by Indian of origin. But if you look at the Indian stocks, they don't have they're not really into the hardware space. And there's also some concerns that AI could be an impact, a negative impact to some of the large companies that offer things like IT services. So there's been a debate in financial markets as to whether India actually is a beneficiary, of AI or not.
So how closely correlated is the equity market in India with the overall economy?
It's very closely correlated. So India has slowed down somewhat this year, and we still expect over the medium term that it's still going to be the fastest growing major economy in the world. So, maybe over the last 10 years it was growing at, say, 8.5% GDP, and we think it's going to grow at about 7 to 7.5% going forward.
Let's change gears and look at China, where there seems to have been a great deal of cross currents. Now, we know that the export economy is holding up reasonably well. It's domestic demand that remains the problem. How do you view the outlook for the Chinese economy in 2026? Would you call it upbeat?
I think the short answer is yes. And you've seen that across the board. Many economists have recently upgraded their GDP forecasts, like we did as well at Bloomberg Economics. Maybe a few months ago, we're expecting, GDP to slow down to 4.2% in 2026. And we've recently, upgraded that to 4.45. And I think that's been reflected by other sell-side brokers as well. But as you sort of mentioned, but it's mostly due to the strong exports rather than the domestic picture.
What about the market for initial public offerings of Chinese firms in the new year? Do you expect it will be more heated than it was toward the end of 2025?
So most of the IPOs have happened in Hong Kong. And, Hong Kong right now, I think it's still the case. It's leading the world in IPOs this year. And we spoke to Hong Kong Exchange, and they've got over 300 companies on the backlog waiting to list on the exchange. So it's a massive backlog, and 80 to 90% of those companies are mainland companies.
But when it comes to deploying the funds raised by those IPOs, how is that capital being put to work?
Yeah, it's being deployed for their overseas operations because there's capital controls in, mainland China. So it's a great way for them to raise funds offshore for their offshore expansion.
What about the relationship between the U.S. and China? At several moments during the past year, this was very, very heated. Obviously, tariffs a big part of that story. There was also the story on export controls from the U.S. side, and from the Chinese side, restrictions on rare earths. Do you have a sense of how this relationship, the one between Washington and Beijing, will develop in 2026, and the way in which you expect it to affect markets going forward?
It's hard to say. I would say that the relationship does seem to be thawing somewhat. It's been a few months where there's been there's been some tariff scares, so things seem to be improving slightly. Having said that, if you look at what's happened to the share prices and the markets, they've really shrugged off a lot of the concerns regarding tariffs. If you remember at the beginning of this year, China, Korea, Japan were supposed to be the markets that were most impacted negatively by tariffs. But they've actually done extremely well. So in one way, I think the risk has been subsided.
There's no mistaking the deflation problem that China has right now. It's definitely undermining the confidence in the property market still. And I'm wondering whether or not that could show up in a meaningful way to erode confidence in the Chinese equity market.
Well, you're right. The domestic picture still looks subdued. Property prices are still forecast to fall. We've got, property prices falling by about 2%. And the authorities are aware of this, deflationary issue. They've implemented some measures you might have heard of, like the anti-involution push. Mm-hmm. And that's really like a measure to stop the cutthroat competition amongst a lot of these, companies. And we're starting to see some abatement in terms of price competition. We can talk about the material sector for a start. So there is some green shoots that, this could, alleviate the deflationary concerns.
But there's still the issue of overcapacity, which the government has to address, right?
Oh, yeah, it's true. And there's still too much competition in many sectors, like the electric vehicle sector is like a classic example. There's still too many competition in most industries. That's their way of trying to improve the competitive landscape, but it's still too early to say whether it's going to work or not.
It seems like China's been very effective in becoming less reliant on the United States as a market and pushing for other relationships, whether in Asia or Africa or parts of South America. Even so, the U.S. is still reliant on Chinese manufacturing, isn't it?
Well, we can just look at the trade figures. The trade surplus in China has broken, $1 trillion by the end of November. So it's been really strong, and I think that's almost a record. So this has come when exports to the US has fallen, and they've been able to offset that by exporting more to Southeast Asia, Africa, and Latin America. So the numbers speak for themselves. They have been very successful in offsetting the reduction in US exports to other markets.
When it comes to the notion of more policy stimulus from Beijing, I'm curious about what Bloomberg Intelligence is saying about the new year. Should markets hope for a shot in the arm?
Yeah, so we don't think there's going to be like a big bang stimulus. So that's the short answer. I think we'll see, little measures here and there. You saw measures like the cash for clunkers earlier this year. But if you look at, the measures, there could be some move away from sort of monetary policy more towards fiscal policy expansion, but don't expect something, like a big bang going forward.
I'm wondering about the conversations around a forecast for 2026 that may be a little outside consensus.
I'm not sure if it's a big surprise, but the major issue right now, and it's a global issue, and we hear this all the time, is, are we in a AI bubble or not? There's still a lot of concerns of whether there's been, the infrastructure spend, especially with the Mag 7 in the US. I would say in Asia, especially with the Chinese tech companies, they're spending a lot less in terms of, data center capex than their American peers. So they're spending roughly 1/10. So I think the risk is somewhat less in Asia regarding that. But that's, there's other themes as well that could, pop up next year. I discussed earlier that this year has been, I guess like the big themes has been like AI, defense, humanoid robotics. We think next year, based on our thematics analyst, humanoid robotics could get another, could come into the spotlight again, and also space as well, especially with Elon Musk announcing that he's looking to IPO SpaceX. So some of the companies leveraged to the space theme could get some, emphasis next year.
John, we'll leave it there. Thank you so very much. Bloomberg's John Lee. He is Research Content Manager for the APAC, joining from Hong Kong. And I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and all the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.